Let us define the key terms in plain English. A capital gain happens when you sell an investment for more than your cost basis. A capital loss happens when you sell for less than your cost basis. Cost basis is generally what you paid including certain adjustments. Realized means you actually sold and the gain or loss is locked in for tax purposes. Unrealized means it is on paper only. Short term generally means you held the asset for 1 year or less. Long term generally means you held the asset for more than 1 year. Short term capital gains are taxed at ordinary income rates. Long term capital gains are typically taxed at preferential rates, and capital losses follow a matching and netting process that we will use to your advantage. Here is the big picture of how tax loss harvesting can reach taxes. Step 1. You identify positions in a taxable account that are below your cost basis. Step 2. You sell those positions to realize losses. Step 3. You use those realized losses to offset realized gains. First offsetting gains of the same type and then netting across types. Step 4. If you still have net losses after offsetting gains, you can generally use up to $3,000 per year to offset ordinary income. Step 5. Any remaining loss typically carries forward to future years to offset future gains and potentially more ordinary income. Over time, Step 6, you reinvest the proceeds in a similar, but not substantially identical investment to maintain market exposure while respecting the wash-sale rule. Step 7, you track the results for taxes using brokerage forms and your own records, and you repeat strategically, not automatically, based on your goals. Now let us cover the matching rules, because this is where many people get confused. Capital losses and gains are grouped into short-term and long-term buckets. Generally, short-term losses first offset short-term gains, long-term losses first offset long-term gains. Then, if there is still a loss left in one bucket, it can offset gains in the other bucket. After netting, you end up with either net capital gain or net capital loss for the year. And if it is a net loss, you can apply up to $3,000 against ordinary income and carry the rest forward. Now the wash-sale rule, because this is the trap that can undermine harvesting. The wash-sale rule generally disallows a loss if you sell a security at a loss, and buy the same or a substantially identical security within 30 days before or 30 days after the sale. That is a 61-day window in total. If a wash sale occurs, the loss is not gone forever in many cases. It is generally added to the basis of the replacement shares, which differs the tax benefit, but default can defeat the purpose if you were counting on the loss to offset gains this year. So in practice, the goal is to avoid wash sales when harvesting. That means you must consider purchases in all accounts you control, including reinvested dividends, automatic contributions, and even IRAs in certain scenarios. With that foundation, let us walk through a step-by-step example with numbers. Example 1. Offsetting long-term gains with harvested long-term losses. Imagine you sold a stock this year and realized a long-term capital gain of $20,000. You also hold an index ETF that is currently down by $15,000 compared to your purchase price. You decide to harvest. Step 1. You confirm the ETF is in a taxable account. Step 2. You check your purchase lots and confirm the loss is real. Step 3. You sell the ETF shares and realize a $15,000 long-term capital loss. Step 4. On your tax return, that $15,000 long-term loss offsets $15,000 of your long-term gain, leaving a net long-term gain of $5,000. Step 5. You reinvest the proceeds the same day into a different ETF that tracks a similar index but is not substantially identical, so you stay invested. Step 6. You monitor the next 30 days to avoid repurchasing the original ETF in any account. Resolve. You reduce the amount of long-term gains subject to tax by $15,000 this year, which can translate to meaningful tax savings depending on your long-term capital gains rate. Now, example 2. Using losses to offset short-term gains, which are usually more painful because they are taxed at ordinary rates. Imagine you actively traded and realized a short-term capital gain of $12,000 this year. You also have a tech sector ETF position down by $10,000. Step 1. You sell the tech ETF and realize a $10,000 capital loss. Assume it is short-term because you bought it recently. Step 2. That short-term loss offsets $10,000 of your short-term gain. Step 3. Your remaining short-term gain is $2,000. Step 4. You reinvest into a different tech sector fund that is not substantially identical, keeping exposure. Resolve. You reduce short-term taxable gains by $10,000, often the highest value use of harvested losses. Now, example 3. When losses exceed gains and you get the ordinary income offset and carry forward. Imagine you have zero realized gains this year because you have not sold any winners, but the market dipped and you have a realized harvested loss of $8,000 after you sell a losing position. Step 1. You realize that $8,000 capital loss. Step 2. Because there are no gains to offset, you are left with a net capital loss of $8,000. Step 3. You can generally use $3,000 of that net loss to offset ordinary income this year. Step 4. The remaining $5,000 carries forward to future years. Step 5. Next year, if you realize gains, that $5,000 carry forward will be available to offset them. Resolve. You get a tax benefit this year and potentially more benefit later, though the timing depends on future gains. Now, example 4. A mixed scenario with both short-term and long-term and multiple harvests. Imagine you have short-term gains of $6,000 from selling a stock held for 8 months and long-term gains of $14,000 from selling a fund held for 3 years. Now you harvest 2 losses, a short-term loss of $9,000 and a long-term loss of $4,000. Step 1. Your short-term loss of $9,000 first offsets your short-term gains of $6,000, leaving a net short-term loss of $3,000. Step 2. Your long-term loss of $4,000 offsets $4,000 of your long-term gains, leaving a net long-term gain of $10,000. Step 3. You then net the remaining buckets. Your net short-term loss of $3,000 offsets $3,000 of your net long-term gain, leaving a final net long-term gain of $7,000. Step 4. You pay long-term capital gains tax on $7,000, and you have no net loss left for ordinary income because it was used up in the netting. Resolve. Harvesting reduced your taxable gains from $20,000 total to $7,000, but note how netting can shift which type of gain remains. This matters because long-term and short-term are taxed differently. Now let us translate those mechanics into a repeatable workflow you can use each year. Step 1. Collect your inputs, your realized gains so far this year, your unrealized losses available in taxable accounts, your estimated income bracket, and any expected big events like selling a business, exercising stock options, or rebalancing. Step 2. Decide your target. Do you want to fully offset gains, partially offset, or create a carry forward for future years? Step 3. Stanford candidates. Look for positions with meaningful losses relative to transaction costs and bid-ask spreads, and consider positions you might want to reduce anyway for risk reasons. Step 4. Choose the tax lots. If your brokerage allows specific identification, select the lots with the largest losses. This can increase the harvested loss without selling the entire position. Step 5. Check wash sale exposure. Look back 50 days for any purchases of the same security, including dividend reinvestments, and plan forward 30 days to avoid accidental repurchases. Step 6. Execute the sale. Step 7. Reinvest into a replacement that fits your desired exposure. For example, sell one Broadus equity ETF and buy a different Broadus equity ETF tracking a different index family. Step 8. Document the trade and the replacement. Step 9. After 31 days, you can decide whether to switch back to the original holding or keep the replacement. Step 10. At tax time, verify your forms and carry forwards, and store a simple annual harvesting law. Now let us discuss replacement selection, because it is where investors either take unnecessary risk or accidentally trigger wash sales. The principle is to maintain exposure while changing the security enough to avoid substantial identity. Common approaches include swapping between two ETFs that track similar but different indexes, swapping between an ETF and a mutual fund with a different benchmark, or swapping between two sector funds that use different index providers. What you want to avoid is selling an ETF and buying the exact same ETF back inside the wash sale window, or buying an ETF that is effectively the same fund with a different share class that could be treated as substantially identical. A conservative approach is to choose a replacement with a different index and different issuer, while keeping the overall asset class exposure consistent. Now let us cover common mistakes and how to avoid them. Mistake 1. Harvesting inside a retirement account. Losses inside IRAs generally do not help in the same way because gains and losses are not recognized annually for tax. Mistake 2. Creating a wash sale by forgetting about dividend reinvestment. If you have dividends set to reinvest automatically, you can accidentally buy back the same security within the window. Solution: temporarily turn off reinvestment for the harvested security before you sell. Mistake 3. Creating a wash sale across accounts, like selling in taxable but buying in an IRA. Solution: coordinate across all accounts you control and post automatic buys of the same security. Mistake 4. Harvesting tiny losses that are not worth the effort or that increase your trading costs. Solution: focus on material losses and consider thresholds. Mistake 5. Ignoring your future tax picture. Harvesting is often a deferral strategy. If you harvest now and later sell a replacement at a gain, you may pay tax later, which can still be beneficial, but you should understand it is not always free money. Mistake 6. Letting the tax tail wag the investment dog. Do not take yourself out of the market for 30 days just to avoid a wash sale that introduces market timing risk. Instead, use a replacement investment. Now let us talk about why harvesting is often a tax deferral strategy. When you harvest a loss, you lower your current taxable gains, but you also lower your cost basis in the replacement if you later switch back or if the replacement appreciates, meaning future gains can be larger. So the benefit comes from the time value of money, the possibility that you will be in a lower tax rate later, and the ability to offset higher tax short-term gains. Today, this is why harvesting is generally most valuable when you are offsetting short-term gains, when you expect to keep investing for many years, and when you avoid triggering wash sales. Here it is. Another practical example focused on the time value of money. Imagine you harvest a loss of $20,000 this year and use it to offset gains that would have been taxed this year. You Reinvest immediately, and over time the replacement position recovers. When you eventually sell years later, you may realize a larger gain because your basis is lower, but you had years of pain, more capital invested, and potentially you sell in a year where you have other losses, or you donate appreciated shares, or you are in a lower bracket. The strategy is not just about paying less tax forever. It is often about paying less tax now and managing when and how taxes show up later. Now let us discuss how harvesting interacts with portfolio rebalancing. Rebalancing means selling what has gone up and buying what has gone down to maintain your target asset allocation in down markets. Harvesting and rebalancing can work together because the positions that fell may offer losses to harvest, and the positions that held up may be where you have gains. In up markets, harvesting opportunities are fewer, but you may still have individual holdings with losses due to company-specific moves. Step by step, you can identify losers you want to trim, harvest their losses, then use the proceeds to buy your underweight asset class via a replacement that keeps your exposure and allocation on target. Now let us discuss a nuance: mutual funds and year-end capital gain distributions. Sometimes a mutual fund distributes capital gains to shareholders near year-end, and that distribution can create taxable gains even if you did not sell. Harvesting losses before distributions can help offset those gains, but you must be careful about buying into a fund right before distribution, because you can end up paying tax on gains you did not participate in. So if you use mutual funds, pay attention to distribution schedules and think about the timing of purchases and harvesting. Now let us cover record keeping in tax forms. Most brokerages will report realized gains and losses on Form 1099-B and summarize on Form 1099, but you still want to keep your own high-level log, especially if you harvest across many lots. At tax time, capital gains and losses are typically reported on Schedule D and Form 8949. The carry-forward amount from prior years matters, so keep a copy of your prior year return and verify that the carry-forward carries through. If you use tax software, it usually imports these numbers, but it is your responsibility to confirm accuracy. Now let us do one more detailed step-by-step scenario that resembles what many investors do in December. Imagine it is mid-December.